today is Aadit Palicha, founder and CEO from Zepto. And hey, Aadit, good seeing you again. And he would be joined by Siddharth Talwar. He's a venture capitalist at Lightbox, and moderating the entire session is Priyanka Sahay, the special correspondent from Money Control. Hello, Priyanka.
Hi, thank you so much. Thank you so much for, introducing us. And let me also tell you that it was quite a stellar presentation which you guys gave. Some really interesting numbers. So we'll be taking it forward from here now.
Thank you so much. Cheers.
Hey, hi guys. Thank you so much for joining in. And, your introduction has already happened. And I would just like to take just a minute to introduce what this panel is all about. And, quick commerce, grocery, we are calling it with multiple names right now, 10 minutes, 20 minutes, or 30 minutes. So while the jury is still out on the ideal time which is required to deliver groceries at our doorsteps, there's clearly no taking away from the fact that online grocery delivery companies have made our lives much better with this pace, this super quick service at this hour. But how easy is it actually to deliver you your grocery in a hassle-free manner? Its business proposition as well as the challenges ahead. This and much more will be discussed in our today's panel. Thank you so much, Aadit and Siddharth, for joining us. Really appreciate your time.
Great to be here, Priyanka.
Absolutely.
Well, so let me begin. Thank you. Let me begin by asking you, Zepto and Dunzo, along with other companies in the segment, are doing incredible work by offering deliveries at lightning speed. But how has it been in terms of the customer response so far? Are they actually valuing this service? And is there a brand loyalty in a price-sensitive market like India?
So do you want to go first or should I take that?
No, please go ahead. Please go ahead.
Awesome. Thanks Siddharth for that question, Priyanka. In a nutshell, the way what we're seeing in terms of response to customers, we're in a position where the metrics that we track, obviously very regularly, week on week / month on month, buyer retention, revenue retention, net promoter scores. We're sitting on at least internally, and I'm sure other of the great e-commerce players will probably have similar numbers, but internally we're seeing numbers that are unprecedented, right? An NPS score stable at about 88 points. We're in a position where month on month buyer retention is almost twice as high as sort of traditional hyperlocal platforms in like a food delivery or a ride sharing space, at least with the benchmarks that we have, right? And so we're in a position where on a macro level, customers are really, really getting addicted to this experience, right? And it's not so much so the 10-minute delivery, I think, that was touched upon and in sort of the earlier presentation. It's actually sort of the overall seamless experience, right? So 10-minute delivery, having a breach rate that's in sort of the low single-digit percentages is one important point. But also, it ends up being what's the freshness of the products that you're actually delivering. What sort of your level of what's the level of in stock that you can provide? Can you start partnering with brands at scale to get better price, get better end state price points for customers, that they might not normally have access to in sort of a local setting. So yeah, I think it becomes a culmination of multiple different things. Obviously, the 10-minute delivery piece is the kicker. We're in a position where that NPS number isn't actually intellectual for us, right? It has very, very tangible real life impacts. We're in a position where our CAC is 2 to 3 times lower what it would have what most investors expected it to be, largely because the organic acquisition that we experience is as high as 60% plus in cities where we're doing aggressive marketing, right? Even despite the aggressive marketing. So look, I think the reaction has been great. In terms of brand loyalty, I believe there is one. But at the end of the day, it's going to boil down to execution, right? And brand is definitely an element that helps you with customer acquisition. It helps you with to an extent, especially as this category culminates into more private label plays,
right,
and sort of more on the fresh category. That's when it'll be more important. Today, it's just largely on execution.
Absolutely. It's largely on execution. Said, Adit has made a very important point. But given the price sensitive market that India is, could you take it forward how easy, how difficult it is to acquire customer and thereafter retain it in a market like ours?
So I don't think, and I think Aadit made a very good point about your ability to make customers happy and that becoming almost a flywheel to acquiring more and more customers at a cheaper and cheaper rate. I don't think that customer acquisition is the problem. I think customer satisfaction becomes a much bigger deal. And that really comes from, again, following up on what Aadit said, a combination of quality, availability, and also price. And I think if you really look at it, the price plays a very, very big role, but it can also be a very, very big advantage. If you're able to procure the items that you want in your warehouse, you actually have a better ability to have better unit economics than a normal grocery store or a normal convenience store.
Sure.
Because you have the advantage of data, you have the advantage of being more local, you have the advantage of having better terms with less and less middlemen. And so your supply chain starts becoming very, very critical. And I think that allows you to be able to reduce your pricing on products and allows you to spend a little bit more on the front end customer experience, including whatever the delivery might have to be, while still making better economics than a traditional grocery store or a kirana store or any convenience store globally.
Right.
So that's really where you need to spend your money initially, not on trying to acquire more and more customers. Customers, I think we've been able to prove in our country, and others have been able to prove in other countries, that there is a massive demand for spontaneous shopping versus a planned trip to a grocery store.
Right. Spontaneous shopping, and especially when you're getting it delivered in 10, 20, 30 odd minutes, consumer also end up buying a lot of essentials and non-essentials, which perhaps would not be required at that time. But given that it is available, given that there are some exotic vegetables, given that there's some fine chips, cold drinks, chocolates, things that you just add on to your basic basket, right? How have the economics played out so far, Adit, if I could ask you? And also, what are some of the challenges in this sector when you plan to make one store profitable as you expand? Adit, if you could take that.
Yeah, for sure. So look, I think in a nutshell, for us, we've obviously, grown at a pace where I think the Indian ecosystem has been a little bit taken by surprise there. I think despite the growth, then the focus area for us has been, turning micro markets profitable, and we're in a position where we've, and transparently, we've hit, full profitability in our first few micro markets, and our other micro markets are trending in even better directions, right? I think there are, multiple different advantages that come with scale. This business doesn't particularly have network effects, but obviously doesn't have network effects like a social networking business. But the interesting thing is that as you garner more and more scale, the barriers of entry for the next player become even more expensive, right? Because your customer acquisition cost is much higher. Yeah. And at the same time, when you're scaling slower, the fixed cost structures that you have on the back end supply chain become much more expensive on a per order basis, right? So if it takes us, let's say, $100 million to get to X revenue, the next person that might need to come into play, becomes 3X as expensive, roughly, right? And so for us, I think the rapid scale has actually, counterintuitively been, pretty beneficial on unit economics. We're in a position where our burn to revenue ratio is as high as 1:4, 1:5, right? Compared to sort of the traditional platforms might have been at, historically, we've seen ratios as low as 1:1, 1:2, right, on sort of burn to revenue. So yeah, no, I think we're feeling quite good about the overall UE profile of the business. There are lots of different advantages that come into play, like Sid was also sort of touching upon on the supply chain side. But yeah, I think right now so far so good. We've got micro markets to that level, and we're excited about the trajectory of our other micro markets, and that's frankly reflecting in our burn numbers, where we can actually get to a significantly higher revenue than historically has been possible in Indian companies or Indian technology startups with a relatively low level of burn, right? So yeah, that's a large focus here for us.
Fair enough. Sid, you invested in Dunzo when it was not into grocery. And you were an early backer, and it took them a lot of years. They started with something else, and now they are incredibly in this field and delivering groceries at lightning speed. Would like to know from you on your thoughts on how economics have played out for one company, which is Dunzo, as well as for the economy or for the industry in general, and where do you see it going forward?
So I prefer not specifically talking about the economics of Dunzo, because I think it's better when founders talk about their own economics. But I think the economics of the industry, I think,
Sure.
And I also just want to say one thing: they're not delivering at lightning speed. These words are this a negative connotation.
20 minutes, 19 minutes is what Kabir talks about, right? Yeah.
Whatever it is, that's lightning and quick. These words, I don't, for some reason in my mind, just make it sound like someone's getting to danger and someone's gonna, something's gonna happen. These are well-planned deliveries. And someone says 10 minutes or 15 minutes or 20 minutes, it's not, it's because it's been planned in that manner. It's not suddenly we're trying to find some guy to get off his bike and go somewhere, and I'm trying to fill up a bag really quickly. I think the economics, and I mentioned this earlier, the economics make so much more sense in this space than almost any other commerce space anywhere in the world. And I think it's so important to understand why that is. If I'm delivering a Samsung phone, just for argument's sake, the margin available without any middleman is very small. And so my ability to make money on that margin is very limited. If I'm going to deliver food from my favorite Chinese restaurant, I know exactly how much margin I can make off of that. And if in order for me to make more margin, I have to negotiate with the Chinese restaurant to reduce their margin. Mm-hmm. Whereas in this industry, your ability to increase margin is your ability to remove the obstacles between yourself and the initial source of that product, where it is an FMCG business or a farmer or anyone who is actually making the product that you're going to be putting here. The other part of it is your ability to acquire data at a local level gives you the ability to be able to know exactly what products you need at what times and where. And so Adit's saying that he's got, these micro markets. Now, every micro market is not the same, and their needs are not the same, and in the hours their needs are not the same. And so your ability to know that allows you to buy in bulk, allows you to buy the right products, allows you to be able to then negotiate accordingly. And no other industry has that power. There are so many inefficiencies in getting a grocery product into a home in our country that our ability to reduce pricing has nothing to do with reduce pricing has nothing to do with reducing margin of a supply chain and harming someone in the same manner as perhaps it would in broad-based e-commerce or in food delivery.
Right. Absolutely. That's a very fair point, Sid. And also, Adit, if I could ask you the follow-up question, when it comes to revenue and pricing models, can you take us through as to what are some of these models that you are currently evaluating and currently you're planning to make money with, Adit?
Yeah, sure. So I think the question is on sort of the overall gross margin profile. But look, I think, and Sid has articulated it very well, right? There are a lot of efficiencies that get built into the supply chain, especially when you leverage the density in Q-commerce, right? When you've got sort of a dense amount of demand that you're able to consolidate, at a micro market level across an entire city, and then consolidate all of that density and that inventory demand in sort of a, hub or a mother warehouse where you can sort of, place even bulkier orders with even better, negotiating leverage with sort of the with sort of the major FMCG brands, or if you're, if you're working with sort of, fresh vendors, there are multiple different, multiple different advantages that get built in there. I think the interesting thing about this model also, beyond just sort of the margin that you make, intricately on the product side, right? And I think that like, again, like what Sid said, is you're actually in a position where the take rate here has the potential to be, very, very high, especially if if you build sort of an efficient supply chain that consolidates density and demand. But more interestingly, I think, like, not only do you have that the kind of demand to get sort of better negotiating leverage on the product side, the user's propensity to pay is a lot higher than, let's say, what it would be on a 24-hour delivery service. Right? People are significantly less willing to pay, let's say, a delivery fee when they're getting a delivery done in 24 hours versus sort of a 10-minute delivery. And I've told you this multiple times before, and I won't be able to go into the operating details, but the counterintuitive reality is that the faster you're delivering, the cheaper it gets, at least from our P&L's perspective. And you're in a position where you're adding value to a customer. You're able to get density on demand, which gives you better product margins, and customers are willing to pay a delivery fee on top of that because the service is valuable, right? So you're in a position where the last part of it is that your last mile is actually very efficient. Like, we're operating on half the last mile cost that any other hyperlocal player in the country is operated on. Even batch players, people that do 24-hour delivery, 12-hour delivery, 8-hour delivery, our last mile cost is about 1/3 theirs, counterintuitively, right? But look, in terms of so for us, I think when we've seen conversion rates improve or decrease as sort of user receivables like delivery fees and packaging fees end up kicking in, we've seen like very, very encouraging results on conversion rates largely holding, which gives us a very clear perspective that not only can product margins be exciting, user receivables can also be exciting on top of that, as like a margin bump that traditional grocers might not normally have access to. And on top of that, you've got a very exciting lever, which is monetization income. You're in a position where you can actually monetize the platform, add value to brands, FMCG brands like a Britannia or a Parle G or a Unilever or a Procter and Gamble, and say, hey, listen, if you search for toothpaste on Zepto, Colgate will show up first, right? And we're able to monetize that pretty significantly. And the most exciting thing is that if you look at traditional e-commerce, they operate at as high as 4 to 5% monetization income. The best thing about this space is that, unlike sort of e-commerce where phone brands, like for example, a phone, the brands are not interchangeable, right? If you're going to buy an iPhone, you're going to buy an iPhone. If you're going to buy a Samsung, you're going to buy a Samsung, even if like there's a banner on the platform that says buy iPhone. But in FMCG, companies spend significantly higher percentage of revenues on brand because products are interchangeable. So this category has even higher potential on that line item. So yeah, that's what we're excited about.
Basically, margin efficiency in deliveries, which you are claiming has reduced the cost of delivery, and thereafter, further expansion broadly what your revenue will ideally be coming from. I will get back to asking Sid. Adit has just made a very interesting point, stating that Indian consumers are willing to pay money to get deliveries done. Would you agree to this? To what extent do you think that Indian consumers would be paying to get groceries delivered at their home? And also, will there be a specific ticket size or basket size for which they'll be willing to pay the money?
Yeah. So,
yeah.
Oh, sorry. Well, to me, right?
No.
Or
yes, of course, you.
So, I think we're very young in the market right now. And whether they're willing to pay or not, and this is, again, I feel like as you start increasing your TAM and getting deeper into the market, if anyone is able to do free delivery, it's this space. I think that the ability to be able to make margin in this kind of space allows for that. My belief is, I'm traveling out of the country right now, and I was in a conversation yesterday, and he would also come here, and he was explaining how expensive delivery is in the West. for a lot of companies that have raised tremendous amounts of money in Europe and in the US, and especially in the US, you're paying, $20, $30 for delivery. Here, I feel like, and so you're paying $20 for a meal and $30 for delivery for a $50 meal. It's counterintuitive in at some level. I think, why should someone have to pay delivery for the sake of paying for delivery? If I'm able to make my money through all the things that Aadit has just mentioned, because absolutely, you can make money on the advertising side, you can make money on your private label side if you decide, you can make money on the supply chain side, and so on and so forth. Can you then give that extra added benefit to a combination of your delivery partner and your customer? And on the delivery side as well, there's so many efficiencies that can take place. You start creating more and more stores closer and closer to your customer, depending on the density of and demand in those areas. You start putting, you start creating all the efficiencies on that side, outside of what the supply chain offers you. I think that the true winner, as far as a customer is going to be concerned, is your ability to get the right product that you want, available at the time that you want it, with the quality that you expect of it, that if you had seen it in a supermarket that you had gone offline, you would have chosen that particular product, like a tomato that you would have chosen, and you get it in the time frame that you would like to have it, but you're not burdened with the incremental cost of delivery, especially when the company that's delivering it doesn't need to charge you to make money. Right. And I think that is really going to set our country apart, at least, as far as this service is concerned. And that's what I honestly feel the TAM for this space is significantly greater than any other space. I can't imagine that a food delivery company can do their business and not charge for delivery. It's not possible. At least in the math that I've been able to see, it's not possible. And so the smartest delivery guys in instant grocery, instant convenience, are going to be able to figure out that more and more people will use their service because they're getting a great deal without that company having to massively discount and give them that offer.
Exactly. So there are two things that you spoke about. One is the assortment. If you actually have the assortment, and if you're meeting the right requirement of the consumers, which perhaps your competitors are not able to, you'll just be there out there and you'll be the winner. One thing which I would just want to clarify from you, are you saying the delivery will be required or not required? A delivery fee, will that be important factor to retain consumer? Do you think that letting go of delivery will be important, or do you think that the consumers can be paying delivery fee?
I think to increase the TAM, I think our ability to be able to offer them at the without a delivery fee is the answer. Now, I'm also spitballing here a little bit, so you have to bear with the fact that this is a very new industry. Yes. Will everything that Aadit just mentioned play out exactly the way? No, I don't know, and he doesn't know. We're experimenting in this industry right now, but the roadmap looks like that's possible. FMCG companies spend more money on advertising than anyone else. We all know that, and so why would they not spend money here? If I advertise as an FMCG company, I know that someone will be attracted to my product versus like Aadit said, if I'm advertising an iPhone, but if a customer wants to buy a Samsung, I'm not going to, this ad is for iPhone. Oh my God, I'm going to go buy that iPhone. But he might do that for Britannia.
Right. Fair enough. Fair point, Sid.
That works. If all of these things work, then then I think the true customer experience will come from the fact that I can get this and not have to pay for that delivery charge. Right. Because the economics are so beautiful.
Fair enough. Fair point, Sid. And now just a quick question from Adit. I understand that Zepto has started charging its customers in select markets for delivering products to the tune of 15 to 20 rupee, perhaps a little more than that. But there's a lot of discounting also that happens. So essentially, the delivery fee gets waived off. But going forward, do you think that there's a market in this space without charging delivery fee from the consumers?
Look, it's an interesting question. I think again, Sid put it well, which is that in an industry like this, you're in a position where you can actually build the lowest cost supply chain in the world with a Q-commerce model. Again, counterintuitively, right? And you see this with sort of convenience retail as well, offline convenience retail. If you sort of study in detail, how 7-Eleven built a high-touch supply chain, how Tesco Express operates, multiple different models, right, globally. The counterintuitive reality is that you can actually build a very low cost, high touch supply chain to actually make this possible. So is it definitely on the cards? I think so. Like, we're in a position where our last mile costs are already at very encouraging numbers. See, the way that I would look at it is simple. Like, at the end of the day, you have a certain cost structure and you have a certain profitability margin that you're going for, right? Whether it's what traditional retail operates at, which is a 7% plus EBITDA. That's what we've seen in our mature micro markets, right? Can we sort of can we potentially do better than that? I think so. But the long and short of it is that you have a certain cost structure, you have a certain margin that you want to get to, or a certain gross margin that you want to get to. If you're doing a discount and you're also charging a delivery fee, it's the same as not doing a discount and not charging a delivery fee, in practice, right? I mean, if you look at sort of the P&L on a unit level. So it ends up becoming experimenting with multiple different constructs to see what's going to get us the best conversion with sort of the same intake from customers. So I think, yeah, there are constructs that we've experimented with where we've been able to maintain profitability, where there are no delivery fees, but there are also no discounts, right? And so there's a little bit of a trade-off there, and that's in the long term. We'll see how what conversion is better for, like, what do customers prefer? Would they prefer a price off on a product? Would they prefer free delivery? At the end of the day, we need to get that same take rate from a customer, which I think is honestly, decent, from our internal data, fairly fairly straightforward and achievable. So
Adit, Priyanka, if you don't mind, if I can just
please go
ahead. Don't you feel like there's enough inefficiency in the supply chain of normal grocery commerce? Of normal grocery commerce, where you don't have to, the word discount makes it sound like I'm getting it at a certain price and I'm charging you less for it. But there should be enough efficiency in the supply chain that's already in existence, which is not good. I'm trying to think of a good way of putting it. It's not efficient. And by improving the efficiency of that, you're already getting the product for less than what someone would have paid for in the supermarket or the Kirana store. And so you're now offering it at a lower price and yet not offering delivery. Isn't there a case to be made for that without calling it in that sense?
No, absolutely. I couldn't agree more. Right? I think again, like this, there is so much inefficiency in the way that groceries are distributed today, right? I mean, even we're talking about local retailers. Even if you look at sort of scaled up large offline retailers, right? So the consolidated brands, there's so much inefficiency in the way procurement is done, the way the supply chain is run, and how what the end state customer experience looks like. That the word discounting is, like Sid just pointed out, it has been sort of misconstrued, right? You're in a position where if my cost price of this piece of inventory for me or for a partner or for for any other player in the Q-commerce space is significantly lower, and I charge on a markup to that, but it's still much lower than the MRP, I'm making a margin, right? And customer perceives it as a discount from what they usually get at. So that and that is sort of to an extent like the DMart way, right? It's definitely possible. Now the interesting thing is, to get there, it requires a tremendous amount of scale and a tremendous amount of supply chain discipline. In terms of scale, I think this is the model. This is the model that can get there, right? This business is so high frequency that volume is never an issue. Right? It's more of a supply side problem than a demand side problem. The interesting thing is the supply chain discipline, and I think that's where things get very interesting, which is everything from how what are the SOPs you built out for packaging and sortation of fruits and vegetables, right? How can you keep sort of low cost packaging with moisture still in, in a 12-hour farm to fork value chain. Right? It's difficult. Like it's, to keep the cost structures down and keep that level of freshness up. I think with the scale is the part that I'm not worried about, to get to that super low cost structure where we can, make a margin and also be at a significant discount. It's the supply chain discipline, which I think over the next few years, us and multiple other players will be focusing on to get right. And I think whoever gets that right will really crack this this model for sure. So fully, I guess I couldn't agree with you more there, Sid.
So Adit, one quick follow-up question. You just spoke about high frequency segment that this is. Could you tell us the average frequency of a consumer who orders from Zepto? What is that exactly? Like in a month, how often perhaps a loyal customer of yours is placing an order, and what is an average ticket size?
Sure. So I mean, look, in terms of frequency, mature cohorts we're seeing as high as 3 times a week, right? And obviously we're very interested in seeing, beyond sort of the major metros, how does that develop? Like, we've seen sort of even in tier 2 cities, like sometimes frequency can be even more interesting. At least that's what we've seen with other hyperlocal players. But yeah, today mature cohorts we're seeing as high as three orders per week. 2 to 3 orders per week is something that is attainable pretty comfortably. In terms of average order values, right? So here's the counterintuitive reality. There are 2 types of companies out there, right? You've got companies that work incredibly hard so that they can charge customers or expect sort of the maximum intake from a customer, like an Apple. Apple does that tremendously well. Then there's another type of company, which is like an Amazon, which works incredibly hard to make sure the customer has to take in the least, right? So here's something that seems counterintuitive to people. AOV is not something that we focus on, right? We're already at a point where AOV is fairly healthy. Like you're getting to a 400 rupee AOV here naturally is not super difficult. It's much higher by design than a food delivery, right? And that's what we're seeing a lot of our mature micro markets operate at. It's more so, can we bump up? Like it's less so can we bump up the AOV? It's more so, how can we build a supply chain that's profitable on an AOV like that? And very frankly, we've been able to do it. So getting to a 400 rupee AOV is pretty comfortable. Beyond that, would we want to go higher? My answer is no, right? Because the higher I ask a customer to pay, the lower my frequency is. The lower my frequency is, I lose volume benefits that my last mile cost takes a hit on. And then my overall value prop just starts getting diluted, right? My retention starts taking a hit, so I want to pay more on that front. Customer acquisition cost becomes slightly more expensive. So my philosophy is, here's an AOV that's already fairly healthy, especially for a hyperlocal company. Can we build a supply chain that can accommodate that AOV instead of force feeding a much higher AOV to a customer that's comfortable ordering 3 times a week with 400 rupee baskets? Right? So yeah, that's the thought process that we have.
Fair enough. And, even as we speak, we're getting tons of questions from the audience. Let me take this one question that has come. So this person has asked is the TAM restricted to tier 1 cities where there are demand for quick deliveries? Adit, could you take that?
Sorry, me or Sid?
Okay, no, Adit, if you could just take that and Sid can follow.
Sorry, I missed that last part. No, I think, look, in terms of TAM, very honestly, right, we're in a position where the top 20 cities, is looking like a very large game, right? I think like pre-competition, the overall, and I think this was sort of touched upon in the presentation earlier, right? Like pre-competition, we're seeing very conservatively revenue potential, not TAM, revenue potential being north of $30 billion, right? And at a pretty reasonably high multiple, because it'll be high growth, relatively high gross margin, right? When you compare sort of all the different factors you spoke about, better procurement efficiencies, potentially delivery fees, and definitely monetization income, right? So the top 20 cities is to me a much larger game, but I think there's a bias that potentially I'll have to overcome internally, which is beyond the top 20 cities. What I'm seeing right now, sort of the early experiments, is that my initial assessment could have actually been wrong, where there's actually potentially even more demand than I anticipated in markets like those, for different reasons, right? Not again, like 10-minute delivery is not the product of the market. That's sort of somewhat of an erroneous assumption that people make. It's more of a means to an end, right? How do you get to a high frequency use case basket? The way to do that, the higher the frequency the purchase, the lower a customer's ability to tolerate friction, right? Because if I'm ordering once a month, then I don't mind waiting 24 hours for a delivery. But if I'm doing it 3 times a week, 24 hours is tough, right? I can't do that as much. So look, I think, when we've seen markets beyond the top 20 cities, we've done experiments that have, although the top 20 cities are, in and of itself, like an unfathomably large TAM, we think that there's probably an interesting opportunity beyond the top 20 cities that, probably internally we also haven't given enough credit to. And so, yeah, I think for us, it remains to be seen. The exciting thing about this model is that the cost of experimentation is so low, right? And Sid would also probably see this in the players that he's invested in. For us to open a dark store or to launch a micro market, right? The risk capital is only about $6,000 to $7,000.
Sure.
85% of the upfront investment is movable, right?
Mm-hmm.
So or recoverable. So you're in a position where we can experiment, and I'll come back to you 2-3 years later with an answer. And if it goes well, fantastic. And if it doesn't, it'll cost us a few $1,000s.
Yeah.
So yeah.
Sid, I would want to ask you this follow-up question. This segment, now I know you have reservations calling it maybe a quick commerce or express commerce, but this segment wherein consumers are being offered essentials, groceries, goods in a considerable, in a short span of time, is something which has been very popular in the Western markets as well, in the global markets as well. But of late, we are seeing that there are issues that the global markets have started to witness, and there are consolidations that have already started to happen. There are some companies that have gone back to the drawing board and have said that perhaps 10 minutes is a little too quick. They need to expand it by another few minutes. So what is your take on that? What sort of a hope do we have in India as we speak?
We have a lot of hope. We have tremendous hope. Priyanka, can I just say something on the last question just for 1 minute?
Yes. Why don't you say that, and then we'll take this question up.
I think that I see this question a lot. Is this a tier 2 play, tier 3 play? Yeah. I always find people that ask that question live in tier 1 cities. And the realization, the response I always have to this is, are you asking that if someone lives in a smaller town, they don't want something delivered to them rather than the inconvenience of them having to go somewhere to buy something? And whereas
in smaller towns, we also have stores pretty next to the houses, no?
You're right. 1 second. And yeah, you're right. But actually, the biggest problem in those towns is supply chain. And so your ability to get a product that you want at the quality that you deserve at the price point that you can afford it is actually much more complex, I think, than in a metropolitan city. And so I think the expansion of this kind of business is not so much, is there a market? Is there a demand? If Aadit goes and sets up a dark store in Surat, I don't think the problem is that people are going to want his product. The problem is going to be, does Aadit have a supply chain that's able to effectively provide the same quality of service at the same price and same level of customer experience as he is in, let's say, Bandra, right? That's the concern. The concern is not supply, the customer demand. This is, in fact, I would argue that it's so much more complex to set up a food delivery company in a tier 3 town because you don't have food. They don't have enough restaurants in that town. You're setting up your own warehouse. So it's on you. It's contingent upon you to be able to create the right customer experience rather than expecting others to be able to create it for you and you just being a delivery service. We're not a delivery service. We are a customer experience. Delivery is one aspect of it. So anyways, I'm sorry. I just wanted to add to that last one.
That's a very valid point. And I'm sure that companies are actually looking at this side of the business as well. And I'm sure, and rightly said, in case if you're able to offer consumers what perhaps they're not getting in the local market with the convenience of them sitting at home, why not? Definitely. I agree to your point there. Please go ahead.
Sorry, your question to me.
Yes, my question was on the global market, how this express fast delivery is now being seen in the global markets. This consolidation has started to happen, and there are companies that have decided that they'll perhaps increase the delivery time from what 10 or 15 minutes they were offering earlier. So that's what my question was, as to how do you see this trend shaping out in India in the long term?
So I think the economics of this model are very different in global markets, especially Western markets, than in India. And I think a 10-minute delivery or a 15-minute delivery or a 20-minute delivery is the smallest aspect of that is the speed at which the delivery guy gets to your house.
Mm-hmm.
That's the last leg. It's like in a football match. You can't expect the goalkeeper, after the ball has gone through 10 other people, it's the goalkeeper's fault for not saving the goal, right? You've gone through everyone else on the team. The 10-minute delivery is about your ability to have the store in the right place, your efficiency within the store to procure products, so how you handle incoming order, your ability to be able to have the technology to be able to facilitate all of the different things in order to give it to that delivery person at the right moment, and for that distance to be covered to be the right distance for you to deliver that product. And I think we are much better prepared in our country because of the inefficiencies that exist today
in the market.
Make this work in a profitable manner. And I think the other aspect of this is, at least globally, and we'll see how this turns out in India, because we're just starting off right now. The immense amount of competition to destroy other people and with spending money has forced people to have to raise tremendous amounts of money, constantly fundraising in order to just survive and try to keep pace, rather than using that money to improve the experience and their ability to improve their unit economics by spending in the right places, like their supply chain and the relationships with the final procurement, whatever that might be. Here, I'm hoping that companies that raise, and I'm sure companies here will raise lots of money as well, but I hope that money is spent for the right reasons and not the wrong reasons, and we're able to get margin for all the reasons Aadit has mentioned. We're able to make that money so that we're not spending money trying to just keep pace, but actually spend money to improve the customer experience. And that will then create that flywheel, which will bring more customers, expand our TAM, and be able to build these behemoth companies that I can only imagine how large some of them will get. I think we are seeing the tip of the iceberg of commerce so far in our country. And we are nowhere close to global standards as far as value is concerned or sizes are concerned. And I think that that's really going to be achieved by companies in this space.
Yeah,
Fair
no,
enough.
and let me just add something there, Priyanka.
Sure.
If that's all right. And I think, again, Sid has done a great job sort of articulating this, but specifically, and just to touch upon sort of your macro point on sort of the markets, right? We transparently, we love markets like these. I think these are markets where capital consolidates with players that have the most operating discipline, right? Especially in markets like these, and a lot of sort of untenable, unnecessary challenges get wiped out when the cost of capital becomes very expensive, and consolidates around people that have the best use of capital, like people that can get, in a crude sense, the maximum bang for your buck, right? And so we honestly love markets like these, and I think and I'm sure Sid has seen something similar. Players that are executing, and for us as well, right? Touch wood, capital access has largely been unperturbed. It's even in markets like these, even in sort of the midst of a global meltdown.
So fair to say that your next round of funding is pretty much on the line.
No, I see. Look, I think it's a very nice thing to say. I think for us, we're in a position where it's not so much like a next round of funding. That's not how to approach capital in this model, right? In this model, like Sid said, the potential here is so massive, And the growth rates, frankly, and not just for us, right? I mean, I think, we've grown incredibly fast. That, we're doubling every month. But I'm sure everyone has seen sort of tremendous growth rates because the TAM is so large that, capital becomes a bottleneck to that growth. And so you're constantly raising, right? There's never a period of time where you wouldn't be raising. So it's not so much, we've got a next fundraise is closed and this fundraise is closed. It's always just like, let's sort of keep the tap open. So yeah, I think, and like that's how I have a sense of sort of how the capital markets are reacting, right? Not because we're in the middle of a fundraise, or we've closed a fundraise, or we're announcing a fundraise. Right? That's not always a cycle that it's at. So it's just because we've constantly got our fingers on the pulse and saying, okay, when can we raise? And if we raise, at what price? It's at that level, right? People now have conviction in the model. It's not so much so can you raise? It's more so what's the cost of capital today that I can raise at? And how does that fluctuate? And do I want to pull the trigger today, or do I want to pull the trigger tomorrow? And that's how most great companies are operating at, right? And so yeah.
And are you saying that there's not been any impact in the last couple of weeks or months on the same, given the sort of market situation and the global sentiment?
Look, I think I only have sort of a sample set of one, right? I'm sure, again, Sid being an investor will have some deeper context. But like in our situation, like I mentioned, I think a lot of investors have seen this movie play out, right? Large TAMs, competitive spaces, markets eventually do slow down. People don't just get funded like crazy forever. And at that point, the players that win have got the best operating discipline. So I think for us, it's, the most important piece has been positioning ourselves as the best operating discipline. And that's been, tremendously effective. Like we're in a point where, I would actually, make the counterintuitive argument that it's been slightly easier to engage with investors. Investors, might be in a position where, their qualm with the market is, there are, tons of players and everybody's getting funded. All of a sudden, nobody's getting funded. And so now this becomes a lot more exciting to investor because, you're in a position where a year or two from now, there's going to be like a number of players that, potentially will get wiped out, right? And so that looking at that in the horizon is a lot clearer in a market like this. So there are investors that are even like, I think the investors that we usually spend time with and respect are equally excited because the operating discipline hasn't changed. And the investors that normally wouldn't engage with the market because they wanted to cool down are saying, wow, this is now an opportunity for this market to cool down and players to consolidate around the companies that have the best operating discipline. So frankly, we've gotten better engagement, but broadly, again, like I mentioned, right, it's not so much an element of this fundraiser is being closed and that fundraiser is being closed. It's more so you're constantly raising. What's your cost of capital today, and do you want to pull the trigger today or tomorrow, right? So yeah.
Very valid point, Adit. And again, on those lines, this other question that I have, both of you, please try to answer that.
I'm so sorry. This has been such a pleasure, and it's almost like a freight train, and we can't really stop. This is a hot potato, and it is what it is. But unfortunately, we have run out of time. I'm really sorry about this. As much as I want to hear you more, but unfortunately we have another panel.
Not an issue at all. It's been a pleasure. It's been a great pleasure having both the panelists on the panel, and lovely engaging with both of you, Aadit and Sid. Thank you so much once again for taking time out.
Wonderful interacting with you, Priyanka. Thank you so much, Sid.